In this video, we'll learn about what is mutual fund and how to invest in mutual fund. So coming on to first the basics of mutual fund. A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's asset and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objective stated in its prospectus. Mutual funds give small or individual investors access to professionally managed portfolios of equities, bonds, and other securities. Each shareholder therefore participates proportionally in the gains or losses of the fund. Mutual funds invest in a vast number of securities and performance and is usually tracked as the change in the total market capital of the fund, derived by the aggregating performance of the underlying investments. Stock market investing offers the opportunity to earn higher returns at greater risks. One way to benefit from stock investing while mitigating some of the risks is investing through mutual funds. Asset management companies, which are called as AMCs, pool funds from the several investors through different mutual fund schemes. The money is then invested in different financial products such as equities, debt, and government securities. The fund objectives of each mutual fund scheme are clearly defined in the prospectus. Mutual funds in India may be classified according to several categories. Here are three of the most common ones: open-ended and closed-ended. You may enter or exit from open-ended mutual fund schemes at any times as per your requirements. On the other hand, closed-ended schemes do not offer such flexibility. You may invest and exit these schemes only during the specified times. Large, mid, and small cap. This classification is based on the size of the companies where the money is invested. Large cap mutual funds invest a higher proportion of the corpus is companies which have greater market capitalization. These mutual funds are less risky because companies invested in have larger market capitalization with several years of performance record. Mid cap funds invest in small sized companies and pose some level of risk but also offer an opportunity to earn higher returns. Finally, small cap mutual funds are high risk, high return schemes because they invest in small companies with the potential to deliver exponential growth. Equity, debt, and balance funds. Another classification method is based upon how the mutual fund invests the pooled money. If a scheme primarily invested in stock, it is categorized as an equity mutual funds. When the scheme puts most of the funds in debt products like government securities, corporate banks, or fixed deposit, it is known as a debt fund. Balance fund invests corpus in both equity and debt products. There are several AMCs that offer a large number of mutual fund schemes. Let us now understand how to invest in mutual funds. You must first identify schemes that match your investment objectives. Some of the factors you should consider include liquidity, expected returns, and your risk appetite. The next step is to evaluate the performance of various mutual funds available in India. One way to do this is to identify the top 5 performers within your investment objectives. You must then check the returns of these schemes over different time horizons and check if they offer consistent returns or at least perform better than the benchmark. An important thing you must remember when investing in mutual funds is diversification. It is recommended that you choose 2 or 3 schemes that match your requirements and distribute your investment amount among these. This helps to mitigate your risk. An often overlooked factor when comparing mutual funds is the cost. Some of these include management fees, exit loads, and annual expenses. These additional expenses may reduce your overall returns and are an important consideration. Some mutual fund schemes also offer tax benefits. These equity-linked saving schemes also allow you to save tax on up to 1.5 lakhs. In addition to that, the interest you earn on the money are also considered tax-free. Investing in mutual funds offers several benefits due to recent changes made by Securities and Exchange Board of India, and also AMCs are regulated by the stringent laws of SEBI. In addition, these schemes are managed by experienced fund managers that increase the possibility of earning high returns. Entry load have been removed and even exit load is charged by very few funds nowadays. Credit Rating Information Services of India Limited also offers the rating for all the mutual funds based on their performance, which makes choosing a mutual fund a lot easier. All of these factors makes investment in stock markets much easier for non-finance professionals. Nowadays, it is possible for you to invest in mutual fund schemes online. Many stockbrokers allow you to invest in mutual funds. One convenient thing if you plan to invest directly through the AMC is that you already have a Demat account with either CDSL or NDSL. You don't need to fill in the KYC again. Hence, mutual funds offer a better alternative to conservative options such as fixed deposits, while offering much better results while exposing your investment to marginally higher risk. Some of the best mutual fund investment apps that we found are SBI Mutual Fund, HDFC Mutual Fund Online Investors, LIC Mutual Fund, Kotak Mutual Fund, ICICI Mutual Funds Easy, and Aditya Birla Mutual Funds. The links to all of these are given in the description below, and you can also visit our website StockQuantum.com for more information.